Okay, we're back with AP Macro, and we are still on Unit 3.6, Fiscal Policy and the Multiplier, but we are now in Part 3, and we're going to talk about the tax multiplier and also revisit non-discretionary and discretionary fiscal policy. So, we talked about the multiplier and how we use it to show how an initial change in spending will cause more spending to go on, and how we can use it to figure out how much an initial change will change the whole thing. Now, the other tool of fiscal policy besides government spending is also taxes. So now we need to talk about how does taxing change the spending, or the consumer spending. So what about taxing? The multiplier effect also applies when the government cuts or increases taxes. But changing in taxes has less of an impact than changing government spending. Why? Because consumers are the ones that see the change first. With government spending, the government just spends the money, it's out there, that's the initial shock, that's the new money. But when you change taxes, whether you increase them or decrease them, the consumer experiences that first, and MPC is going to affect them, because if MPC is 0.5, or in this case 0.75, then that consumer is going to save 0.25 of whatever change in taxes you do. So assume MPC is 0.75, so the multiplier effect is 4, because 1 over 0.25 equals 4. If the government cuts taxes by 4 million, how much will consumer spending increase? It's not going to be 4 times 4, because that 4 million, some of it consumers are going to save. So when they get the tax cut, consumers will save 1 million, because MPC is 0.75, therefore, and MPS is 1 minus 0.75, so MPS is 0.25. So if they get a $4 million tax cut, meaning they get $4 million extra dollars, they're going to save 0.25 of 4, which is 1 million. And then they will spend 3 million. The 3 million is the amount magnified by the economy. We take 3 times the multiplier, and it equals 12. 12 million increase in consumer spending. So the tax multiplier is the same exact thing as the spending multiplier. We just have to account for the amount that the consumers are going to save. The government spends all the money, so we can take all the money times the multiplier. But tax multiplier, those consumers are going to save some of it, so we have to account for that. So we have a new formula for the tax multiplier. If MPC is 0.75, what is the tax multiplier? This is how it works. You take MPC times the spending multiplier, or it looks like this, and that'll get you the tax multiplier. But the simplest way to figure it out is that the spending multiplier minus 1 is the tax multiplier. So if the spending multiplier that we figured out from over there was 4, 4 minus 1, tax multiplier is 3. That's the easiest way to remember it. If you figure out the spending multiplier, just subtract 1, and that'll be the tax multiplier every single time. So if the spending multiplier is 4, then the tax multiplier is only 3. So the tax multiplier is always smaller than the spending multiplier. It's always 1 less. So just make sure you know that. Remember that an increase in taxes decreases GDP. So the tax multiplier is always negative. So it's 1 less, and then you make it negative. Because if we increase taxes, that's going to cause AD to go down, because people will have less disposable income and consumer spending will go down. But if we decrease taxes, that's going to cause AD to go up, because people will have more disposable income and they will spend more. So that tax multiplier in your head is always negative. Just keep track of that. So the total change in GDP in this case equals the tax multiplier times the initial change in taxes. All right. So let's do a little practice with what we've talked about with AD and AS and fiscal policy. So Congress is using discretionary fiscal policy to manipulate the following economy. MPC is 0.5. First of all, when you look at this, what gap is this? So we've got our equilibrium employment over here on the left side of full employment. So we know that we are making less than we should. We're doing about $80 billion in GDP when we should be doing $100 billion in GDP. So therefore we know that this is a recessionary gap. We're not making as much as we should. We are moving more slower than we should. What options does the government have if we're in a recessionary gap? So they need to use contractionary fiscal policy. And what two things can they do? They can change taxes, and in order to get us out of a recessionary gap, they'd have to cut taxes or decrease taxes. And then, or they could change spending. And in order to get us out of a recessionary gap, they'd have to increase spending. So, how much should they increase government spending to get us out of this gap? So this right here, how much do they need GDP to change to get us out of the gap? It's got to be 20, because we're at 80, we need to get to 100, so they need GDP to change by $20 billion. So the total change in GDP equals the multiplier times the change in spending. We'll just put that, which is what we're looking for. How much should they increase government spending? So let's figure out this multiplier, and then we can figure out the rest. So MPC is 0.5. MPS then is 0.5. The multiplier equals 1 over 0.5. We move the decimals. 10 divided by 5 equals 2. So 2 times what will equal $20 billion? And the answer is 10 billion. Okay? And then down here, how much should they cut taxes by? Well, we know the multiplier is 2, so the tax multiplier is 1 minus 2, which is 1. How much should they cut taxes? 1 times what will equal 20? They got to cut taxes by 20 billion. All right? And the negative sign shows that we're cutting taxes. So that's how that works, and that's what we use it for. So the questions will either ask you something like this: how do we get to that $20 billion in total change in GDP? Or they'll ask you, the government spent 10 billion, how much will GDP change? So you got to figure out what are they asking, and then which goes where and what formula. All right, let's stop and pause and talk about non-discretionary fiscal policy. Remember, discretionary fiscal policy is when Congress passes a law right now to fix a problem right now. But non-discretionary fiscal policy is legislation or laws that act counter-cyclically without explicit action by policymakers. So they passed it a long time ago, and it acts to balance the business cycles ups and downs. So AKA we call them automatic stabilizers. So one big example is the U.S. progressive income tax system, and it acts counter-cyclically, meaning it's trying to push the cycle back into the normal realm to stabilize the economy. When GDP is down, the tax burden on consumers is low, promoting consumption and increasing AD. So automatically, because the progressive tax system taxes people at a higher rate the more they make, if GDP is down, automatically the government is collecting less taxes because people will have smaller incomes. So then they get to keep more of their tax money, which means consumption will go up and hopefully AD will go up as well. Or when GDP is up, when we're in an inflationary gap, automatically people are making more money. So automatically they're being taxed more because they have to have a higher percent. The higher percentage, the more they make. So that creates a bigger tax burden, which causes consumers to spend less, discouraging consumption, and that decreases AD. So that tax system, progressive tax system, automatically tries to balance things out by automatically increasing taxes or automatically decreasing taxes depending on where GDP is at. So the more progressive the tax system, the greater the economy's built-in stability with this example. One other example of non-discretionary fiscal policy that the government does is unemployment and welfare benefits. They act counter-cyclically to stabilize the economy. So when GDP is down, there's lots of people unemployed, so there's going to be more unemployment benefits paid out, which will cause consumer spending to go up. This will help AD. When GDP is up, unemployment is lower, there's less people on unemployment, less people getting welfare and unemployment benefits, so then spending will go down, and that will cause GDP or AD to go down. So That's non-discretionary fiscal policy. I just want to go a little bit deeper on those two examples with the progressive tax system and welfare, to help you understand that a little bit more.